Why traders fail prop firm challenges. Real 2026 data. Prop firm pass rate sits somewhere between 10% and 20%. That means 80 to 90 out of every 100 people who pay for a challenge walk away with nothing. And here's the part that surprises most people. It's usually not because their trading strategy was bad. It was because a handful of very specific, very avoidable rule violations. Let's break down exactly what's going wrong. What a prop challenge actually tests. Here's the thing people misunderstand going in. A prop challenge isn't really testing whether you can predict the market. It's testing whether you can operate inside a strict set of risk constraints under pressure consistently for a defined period. Firms aren't looking for one lucky home run trade. They are filtering for traders who can survive their own rules. And most retail traders, understandably, have never had to operate under specific kind of structure before. That mismatch is where most failures start. The 5 rules that decide almost every evaluation. Across most prop firms, 5 parameters determine the outcome. Profit target, typically 5 to 10% of the account. Maximum drawdown, usually 5 to 10% total. Daily loss limit, commonly 3 to 5% in a single day. Minimum trading days, anywhere from 0 to 4 on the low end, up to 40 on stricter programs. Banned strategy clauses, restrictions on things like high frequency trading, copy trading, or trading straight through major news events. Here's the detail that trips people up the most. The difference between a static drawdown and a trailing drawdown. A static drawdown is measured from starting balance and doesn't move. A trailing drawdown moves up with your equity as you profit, which means a trader who's up 4% can still disqualified by giving back a smaller amount than they think because the flow moved with them. Not understanding which type you are on is one of the single most common ways people get eliminated without realizing what happened. The number one cause, over leveraging. If there is one specific mistake that shows up again and again across prop firm data, it's oversized positions relative to account size. The logic is simple but brutal. On a $100,000 account with a 5% daily loss limit, that's hard selling of $5,000 in a single day. Lose $5,001 by market close and the challenge is over, regardless of how the trade might have played out if you had been given more room. A single oversized position taken with conviction instead of a pre-calculated size is often enough to end an evaluation in minutes. The second cause, fighting the rules instead of designing around them. The traders who consistently pass don't necessarily have a better strategy than everyone else. They tend to do one specific thing differently. They read the specific rule set of their specific firm, they place a single trade, and they build their position sizing and trade frequency around those exact constraints, not around a generic how I normally trade habit. Every firm's rules differ enough that a plan built for one firm can get you disqualified on another. The psychological layer. Underneath the rule violations, there's usually a familiar psychological pattern. Overtrading to hit the profit target faster than the account structure actually allows for, and revenge trading after an early loss to catch up before the evaluation window closes. Both behaviors push traders directly into the risk limits the challenge is designed to catch. The account that pass tend to belong to traders who treat the profit target as something to reach eventually, not on a self-imposed deadline. What actually separates pass from fail? Based on the patterns across multiple prop education sources, it's rarely raw trading skill that separates the 10 to 20% who pays from everyone else. It's a short, boring list, knowing you are exactly lost selling in dollars before the session starts, pre-calculating position size instead of eyeballing it, and treating the rules as the actual game being played, not an obstacle around your real strategy.